The stock market failed to close above the 200 DMA and it looks like inflation is still sticky. Hello, ladies and gentlemen, and welcome back. Today we discuss the CPI report in detail, options expiration heading into a quadruple witching event, trillions of dollars at stake, and of course the hottest levels for stocks, commodities, and cryptos right now. A lot of rejections and some massive zones coming up. Well, welcome back everybody to the Daily Show. As usual, we'll go through the macro news and of course the lead indicators, then the hottest charts later on to the show itself. But let's begin with CPI because I think it's pretty clear that there are some problems with this CPI report, even though the market rallied off it. The first thing has to be shelter. Shelter accounted for like 70% of the rise, and you can see using this blue line here how bad shelter is getting out of control in comparison to the rest of the inflation report. There were some good signs. Of course, we saw energy dropping overall. We saw natural gas coming down, and that will help the American consumer, and it helps all of us out there throughout the world. But really, there are still some big problems. Food still increased 0.4%. It was 0.5% on the month of January. And I just think the biggest thing here has to be that shelter, the sticky inflation that we're seeing across the board. Now, I shared some charts over on our channel over on Twitter, FX Evolution, links in the description down below if you're interested. And here's a great graphic illustration of what's actually happening with underlying US inflation. And it looks like it actually heated up. So even though the market's rallied off this result, it doesn't mean it was reacting to the CPI. Instead, what it was most likely reacting to is the overall crunch on yields, which we'll discuss a little bit later. I also thought I'd just quickly bring up this point that I put on Twitter, which is that, of course, the Federal Reserve this week secured American bank depositors in general. They basically said, yes, we're securing cash. That's a great sign. And while this is great for bank bonds in particular, it does also help contagion fears for now. It doesn't mean that it's going to be great for regional banks or banking sector in general. So you've got to be careful about what's happening with stocks. There's going to be a disconnect with stocks and bonds. And this is specifically for the bank bonds themselves, because of course we will see tighter future profit margins. Why? Regulation. So few people are probably going to look at that, but I thought I'd mention it here. It's very important. We always understand with banks what's going on in the financial system. There's still problems, but in general, regulation will come and that will crunch the profits. So don't expect just like huge bounces across the board. We're probably going to see some kind of accumulation event on banks over time. So let's talk about recessions. And of course, we know that there's probably one coming up according to the bonds market. I've discussed that several times. We may avert it, but in general, the bonds market's very rarely wrong. You can see here the number of treasury yields below the Fed target. And overall, we're at a zone that usually has spread danger. These are the recessions in the past, and you can see where we're at right now, basically right on it. We also do know that at the moment, people are talking about T-bills and other bonds being potentially toxic due to the fact that we have so many banks holding unrealized losses. Here's just a chart I brought up in the previous video showing you Bank of America, JP Morgan, Citi, Wells Fargo. You know, we're looking at these and we're saying, whoa, what's going on over here? It looks like there is a lot of unrealized losses. If they're forced to sell, of course, it could put a run on some things. And treasuries in particular are getting a lot of bad flack in the news. I'm not really too worried about treasuries, but look, hey, people are claiming it anyway. When we move over here to the funds rate, this is where the story kind of changes over the last 24 hours. Generally, we got massive cuts. This orange line here represents what happened when the Federal Reserve and basically the government came out and said, hey, we're going to back everybody. It's okay. Depositors are going to be backed. We're going to cover it. We're going to do all of those things. The market said we need accommodation in terms of future Fed yield rates. We were going towards 6% only a week ago, remember, in terms of potentially where we were going to be pushing rates this year. And then it all of a sudden went back down to 4.75 with one more rate hike of 25 basis points included. That's since been an overreaction. You can see the blue line that's here. This one has shown a slight normalization over the last 24 hours, but that wasn't enough to stop the market going up. Of course, the market likes this idea of lower yields. If we're going to see interest rates come down, theoretically, that could be good for technology, certainly good for biotech. Those types of sectors tend to do okay, at least initially, off this type of news. So we know the Fed's probably broken something. They always break something. This chart I brought up so many times. Subscribe to the channel if you're interested in this type of stuff. But I brought it up so many times to just illustrate the fact that we knew something like this would happen. And I don't expect it to be the only break in the system. We've also seen Credit Suisse come under a lot of fire. And I will tweet about that over on FX Evolution. And I'll do a video on it tomorrow talking about credit default swaps, because Credit Suisse is just getting diabolical at this stage. So make sure to check that out. Now, where are we right now? Well, of course, at the moment, we're probably about here in terms of this chart. I brought this up quite a few times. And if we are going into recession, we expect usually the markets to make new lows and then later on to come back. Now, that's a medium-term view. What happens in the next weeks and even month or 2 months could be very, very different. We're in a kangaroo market. We've said that for pretty much the last many, many months. We're in up, down, and all around. What's going to make a big difference, though, for markets will be things like this. Earnings season. Do not forget that forward EPS growth turned negative recently. Now, when we got forward EPS growth turning negative, when we've had this in the past, markets haven't liked it. Here's the cross. Here's the market going down. Here's the cross. Here's the market going down, and so forth and so forth. I mean, this has happened every single time we've seen crosses, except for when EPS turned. And then, of course, we had the Fed bazooka, which led to a massive liquidity charge. And I will be updating you on liquidity. And I can tell you over the last 24 hours, we've seen further spiking of liquidity from the central banks out there. However, it's still not probably enough to push too much higher just yet. So I will see if we get a huge spike in it. I will update you here. Here's another thing that I think we need to consider. If we do go into a recession, ERP, basically the risk that we're taking, will be considered in stocks as well. So this is something that Morgan Stanley's Mike Wilson wrote about a little while ago. If you search ERP Mike Wilson, you can bring it up if you're interested. And basically what it shows you is that there's no real risk premium being taken into consideration when we're talking about stocks. The apes out there and everyone's like all green, all good, everything's great. Yeah, it's all great until something goes wrong. And we've started to see the cracks forming. Again, if it starts to get out of control, and especially if earnings start to weaken and we go into a recession, even if it's just temporary, we will most likely see ERP become a thing that everyone's discussing. The less people that discuss it, the better it is. And obviously that's why a lot of you follow this channel. So when the Fed pivots, we know that stocks tend to go worse. Well, everyone's celebrating the pivot right now. I don't really celebrate a pivot. We don't even know they have pivoted. So we'll find out during the Fed meeting coming up, and we'll basically know whether they're going to pivot, what they say. I would say they still want to take a hard line on inflation. It's clearly sticky, but we'll find out. This chart here shows all of the old previous crashes since we've had basically Fed pivots. At this stage, the correlation is obviously negative. Let's move over to the sectors. Now, this is where we saw rotation from the street come in. And it's been pretty good. I've been following, obviously, utilities the most closely on the channel recently, and there's reasons why. But it was a semiconductor day, communications, and tech. Why did all of those do so well? Well, it's quite simple. It was because we saw a crunching of yield curves. The market stabilized, and then we saw those increase. If we take a 5-day average, you'll see here that utilities is one of the best performers. And believe me, no one was talking about that, I'm sure. So utilities continues to be an interesting sector to me during this next month period. So I'm watching that very closely, obviously watching staples. And this is the rolling 5 days. So gold's been the best place, but gold had an exceptional move. It may have found a little bit of a peaking period. If you're interested in some of this content, remember we are doing a March giveaway for some of our courses. So come on down to the links in the description, click on the little Linktree link, and then of course enter the free giveaway if you're interested. You can also, while you're at it, follow us on some of the other social medias. We're always sharing more information, and we've got amazing communities where all of you like-minded traders and investors and whatever you're doing out there in the investment market can share your ideas and, more importantly, meet up with like-minded people. Let's move over to the VIX, and the VIX was very spiky and now it's dropped off. I'll never understand why people like to buy the VIX when it hits things like 30. You know, I would never buy the VIX when it goes parabolic. It's too dangerous, and I don't actually recommend trading the VIX anyway because the roll contracts are super brutal. You might think, well, I buy VIX every time it goes down to 20 and I sell it every time it hits 30. If only things were so simple, yeah. But we did reject it, and it looks like the volatility's gone out for now. We'll find out whether it can return. Here's one of the forward-dated yields. So I'll just show you here. This is the December yield. So this showed us that we were sitting at 5.6% last week expectation. By December, no rate cuts. Remember, there was no cuts expected for the whole year. And now suddenly there's a 4.34. So that's actually 1 to 2 rate cuts by December. Now, I expect the market had an overreaction to it. So far, it's bounced, but it's very interesting to see that. Let's take a look at some other yield curves here. Here's the US 2-year. I feel like this has changed trend. So if you're looking at yield curves, this big drop-off probably met by buys, maybe comes back up to 4.6, but it does look likely that we're getting close to the topping here on yields. But it doesn't mean that we pivot and turn down in yields. It could be that the Fed goes like this, holds, and remember they're expected to go to 4.75, so it makes sense, holds for a longer period to try to get rid of the sticky inflation. And we've never seen the Fed successfully combat inflation until they've pushed, remember this, until they've pushed the current interest rate above the CPI number. So isn't that interesting? If we don't push the current interest rate above the CPI number, or the CPI comes underneath, we've never successfully combated inflation. We're getting close to that level, but we're not there yet. So I think it's a little bit early to say, oh, we've won the battle. Just for interest's sake, here's the US 10-year, and you can see what's happened here recently. It dropped off, no new low on the 10-year, but it did find a rally as well. Let's have a look at high yield bonds, junk bonds. Not really great sessions for junk bonds. Mostly just kind of opening up and then selling off by the end of the day. A lot of that type of action going on. Something we're looking at, if you go over to something like investment grade bonds, like LQD, they're not really loving the market right now. Again, concerns over whether banks are having to sell some of these things, and TLT coming down after hitting into our critical level. So do I still like treasuries? Yes. Do I think treasuries are going to sit around this zone for a while? Probably. It's going to be a little while. And speaking of treasuries, there they are. So let's move over to DX and the US dollar in general. What are our thoughts here? Well, the US dollar is going to suffer a bit from the Federal Reserve's actions. Basically, when we back everything and we say, oh, it's all good, the government monies, well, not government money they claim, but anyway, we're using the monies to back the financial deposit system. That's not really strong for the dollar index, and dollar will not like a really cutting yield curve like it is. I mean, it's less attractive than it was a week ago to own US dollars, and it's less attractive to own currencies in general. So that's why you're seeing a pump into some other things. Are we at critical levels? We're at one of the most traded zones for the dollar index for quite some time. I like the extreme lows of 102.50 as a potential high. I would like a swing here and then a bullish pick up. And then if that happens, we move generally to this area here. But I don't think there's a clear direction on DXY just yet, other than the current bearishness. And I do expect rallies to be met by sell demand. So I'd like something like this coming into the PPI data. Maybe it hits into here after that, and then we find out the next directions. There's a lot of levels. Nothing's too clear, I feel, on that chart. What about gold? Well, this is a lot clearer. We hit critical resistance. We mentioned it in the previous video. So far, we've moved down. This is a drop and a base and a drop. It's a clear supply. And this came off the previous kind of distribution that we saw over here. So we've had strong gold moves. Why? US 10-year, 2-year, all the yield curves got crunched. Beautiful thing for gold. Also, people think it's a hedge against, let's say, volatility and stuff. Not really. It's a hedge. It's mostly a currency as I see it, but it's become more attractive recently. Do I like gold? Yes. Do I think gold goes up over the next couple of years? Well, I do, yes. However, it's at a critical resistance. So at this point, I kind of like down here at the 1872, and I find this a very tough place to realistically buy, and more it is a sell. If we continue to see yield curves go up and stabilize, then you'll probably see a little bit of sell-off pressure coming in from gold. Critical resistance, we're still pretty close to that point. We'll see how it plays out. Copper, not really selling very much. I mean, it's sitting at 4.02. If we look at it on the daily, and we just zoom that in quickly, you can see it's still down, but it hasn't found that significant weakness showing us that there's some economic collapse or really big problem on the horizon. So no movements there. If we look at staples, this is another sector that some people are looking at the moment. Staples have come up. This is an American, obviously, market, consumer staples. We're looking at this maybe breaching a trend line soon. If we start to see staples move out and utilities, which we'll look at later, then that could give us a sign that maybe the market's bunkering down a little bit for further potential sell-offs. Remember, if these are the best performers in rallies, along with some of the tech stocks, it can show you under the hood there's some danger coming in the markets. What about oil? Well, it finally closed below. We can actually bring oil charts back on. Let's have a look here at the commodities of oil. It closed below the daily closes, and while it's rallying right now, this could mark a little bit of a sell-off. This is an interesting zone as well, so don't get me wrong. We're at the next level of kind of like support. If this gets cracked, well, yeah, 65 is coming, in my opinion. But this still marks, I think, rallies being met currently by sell demand. That's a fairly big level for it to get through. This is super critical that oil holds. If you're a buyer, I can see why you'd be here. I don't like the idea. I mean, basically, if we keep seeing yield curves come down, I believe oil will suffer the consequences of that. It tends to do so. So remember, 65 to 60 a barrel is an incredibly good zone. And I think that if we fail here and we hold another day down, that's going to be very negative for oil barrels. Let's move over to natural gas. So here's natural gas. It came off our level perfectly the other day. It's stabilized a little bit at this point. The Widowmaker is nasty. If you like trading this on the day trade, I don't suggest it. I think it's dangerous, but up to you. Some people will see this as an inverse head and shoulders, left shoulder, head, right shoulder. Do I like it? It's okay. I mean, the stats that I brought up about 2 weeks ago were pretty good for natural gas while we were down here. We've now seen that reversal. If you take a look on the weekly, it looks okay, and it's starting to stabilize base. I could see natural gas sitting around for a while though, so even though it might bounce and find lots of buys and percentages will look good, I could see it being up, down, and all around. Now we'll move on to, of course, Tesla. So did it hit one of our zones? Yes. Did it bounce off one of our zones? Yes. Has it moved up now pretty aggressively? Well, it's gone up 5%. So people will be celebrating this one. Not just yet, guys. Don't just celebrate just yet. We're not fully celebration mode because we're not through this support. So here's the support, here's the resistance. We know that we've got that expected weekly options high coming up. So we are literally, $3 away pretty much from that. And if we hit it, then there could be still some sellers to come in here. Previous support becomes resistance, standard role reversal concept in technical analysis, and of course, an options high sitting there as well. It's also a little gap fill that's probably just sitting above that, which is at the price of, we'll give that to you, 187.49. So interesting levels here for Tesla. I could still see this market coming back down, doing something like this, moving into our 140s, which is, of course, that massive gap fill that sits over here. So, yeah, Tesla's bounced, but it really depends on the broader market itself. Let's refresh the options. As we know, we've got over 2 million units coming into this OPEX. So this is the third week options expiration. And it shows us that the max pain sits at 180. We're currently just above that price. Where are the calls? Well, we've got a lot of calls at 180, a lot of calls at 200. I could still see it coming down. It's actually at fair price right now, according to pretty much max pain. But overall, it's just not going to go above 200. That's what they don't want to do. You would think that's not going to happen. I don't think there's that much help here this week from the options for this one. What about Apple? Well, it just holds in the zone. Pretty boring trading here. There's the daily. There's the weekly. We haven't closed or got to this watch reaction zone. We are in the middle of nowhere. We're approaching the options high, which is sitting at 154.58. Something to check out. NVIDIA continues its AI kind of run. And I think it's so funny how everyone just still buys these stocks and thinks they're so good price. I love the stock. I don't love much, but we're, of course, price action based traders. So overall, this is a potential chance for an island reversal. Still, we're holding in here. We've still got that gap up. I'm looking, I'm waiting. I don't really care about it too much until we see the next move. If you're bullish, there's no reason yet to be scared. Are we approaching the weekly options expected highs? Yes, like many of these stocks, but we still haven't made that gap fill that sits on the left-hand side at 259. So for me, NVIDIA is still bullish, but I'm cautionary on it, cautionary. Let's move over to the Australian market for all the Australian viewers out there. 6949 hit, so that's pretty nice for a potential bounce here. I still don't really like the Australian market too much at the moment. It tends to suffer this period of time generally, and it also can suffer in May as well. But it's come down to what I think is a much more attractive level. You know, I said that up here to you guys, and I stuck with the guns, and we're now at this zone. This is a market I know fairly well. I think it's at a fair level now, but not necessarily a cheap level. So it's down about 8% from the highs. And you can see the difference when you think about the US and you think about this market here. This is filled with banks, but guess what? The banks in Australia have capital controls, and those, let's say, too big to fail kind of APRA rules were a big deal. And I don't think there's much risk of contagion here in the Australian banks at this stage. Let's move over to XLU. So this is the utility sector. You can see it's struggling through that 66.80, looking for a close breakout of that. Possibly a nice move in utilities after that, similar to staples, could show us that the market's a little bit cautionary behind closed doors. So yeah, utilities still doing pretty well. Certainly a zone that I'm liking if it breaks through. Let's move over to the Russell. Nice rally in the Russell. It was the best performer on the day. It was up at 4.7% off the base. Seems good, yeah. Then it ended up at 3.3. Look, the Russell has so many regional banks in it. Obviously, KRE is pretty much a huge component of this. You can see that the banks failed near the end. So the rally that was on KRE, the regional banking, just kind of failed through. And if you look at XLF, you can see here again, the banks are kind of suffering. Now, I think a lot of this is because smart people out there would realize that there's probably regulation coming, and that's going to put pressure on the bank stocks. I actually think if you look at bank bonds, maybe not SVB, of course, but if you look at bank bonds in general, it's going to be a very interesting time. Technically, this is better news for them. So we'll find out whether there's a huge divergence there between stocks and bonds. I mean, that would be the way I'd look at it. Let's move over to the Qs. We've got that big monthly closure. I just always like to point that out because that was our first sign that weird things were happening. We saw a nice bounce to the 61.8 fib that sits here, and we saw a sell-off. Will we continue to see a sell-off for March? How March ends up printing as a monthly is going to be pretty important, I think. Look at the NASDAQ as a futures contract. It just made a new little high over here during the time of this recording. So nice little high, but it switched trends. The NASDAQ has, not the S&P. So this is very important. The S&P didn't. So here's the lower low. We've got that higher high coming through. Drops theoretically should be bought by rallies, but I don't really trust the NASDAQ as much as I trust the S&P 500. So here's the culprit. Everything in this area, 39.80 down to this zone here, which is the 39.40, 39.35 kind of zone, is very important. This is the daily 200, and this is one of the most traded zones. So basically, we've got a 20 moving average. Now, if we do rally, I would see that this kind of being a thing. Okay, if we rally through and we get through this daily 200, sell off, then move forward. That's still a scenario. If we don't and the PPI comes in bad, movement down, and I really like the extreme zones down here. Take that lows, fill some of these gaps, potentially find buyers. I'm not sure if we're going to flash here. There's been too many policymaker moves. We'd have to find out new information that shows us bad things are occurring. But do remember the trend is still down at this stage. We don't have a switch. Here are the expected weekly options highs and lows. If you're interested, just put them on the chart and pause it. And this is the culprit here. So our most major confluence zone, it held so far. We saw a spike into the low demand. We liked, of course, last week, pretty much 38.40 to 37.50. Yeah, I know it's pretty wide, but we do like that zone. And over here, this is the issue. We're coming back up to it, but basically we have this little tough supply zone, which just so happens to be the daily 200 moving average. So we're right on that level. Notice I've also got here 39.68, critical level as well, with a drop and a base and a drop in it. So if markets do rally through, I expect something like this, like that. At this stage, though, bears are in control, so it'll be very interesting to see how they interact with this through the next couple of hours. Let's move into the OPEX. We'll go over here to the 17th. I'll just refresh it so we can look at the options market moving forward. And we'll go to the 17th over here. And you can see that we've got 390 puts still there. So at the moment, it's pretty much working into Wall Street's arms. They claim they want 400 max pain. At the moment, they're 391. 400, funnily enough, would get us pretty much to that 398 area. So yeah, take that with a grain of salt. Still a lot of puts in the system, 400 being the big call level. And yeah, I mean, markets are manipulating for sure, but I'm not really using max pain this week. I think it's with the fundamental data that's out there. I feel like this isn't giving you enough edge in a non kind of options technical week. Now, where other things get interesting is got to be crypto. If we have a look at crypto here, it had to our watch reaction zone, actually rejected it. So I'm going to have a look here at the smaller time frames for you guys. So this is the zone that I've had up for a long time on this channel. I mean, a long time. And we got through and then we failed. Now, interestingly, we actually came underneath here, but we found buyers. If you were really going to see a heavy sell, traditionally, you would see like this, and then you'd see it back up. So yeah, it's a known zone now. That's a known sell-off. I'm not convinced either way, but overall, of course, the trend has been up. Will the bears win this level? They've rejected it, sure. The daily definitely came down. It's very important that the next days hold underneath. And what I want to see is yesterday's low, so the low here, I want to see that taken. When that gets taken, okay, you can say, okay, well, bears seem to be in control of this market. But at the moment, you can see that the rally is here. I don't really know why it's rallying, but if it closes above this zone, I'm still thinking 30K is the deal. Let's move over to the rest of the market. We'll look at the news here. We'll just load it up. And we've got here, as you can see, some information coming out. Core retail sales, PPI coming out 8:30 a.m. New York time. If we scroll down and then we have ECB press conference and monetary policy 9:15 a.m. and 9:45 New York time on Thursday, and then the prelim UOM sentiment. That's the big news for the rest of the week ahead. If you've enjoyed some of this content, then why not check out some of the other stuff we do? Make sure to subscribe, smash the like button, get some free cheat sheets, and of course, enter the giveaway. Bye for now.